we did not have such a good earnings season.
Indian markets have always been expensive.
People have not looked at the risks. People have not realized that these companies are not as strong as they are claiming to be.
Nothing is cheap in the markets today.
You are going to probably see higher US fiscal deficit and potentially higher US inflation.
Clearly, if earnings don't improve from where we stand today, there will be challenges.
Today, there is no difference between taxation of a debt mutual fund and a bank FD.
Welcome to our panel, Is the Market in a Bubble Zone? Following our session on the mutual fund industry's Part 2, rupees 100 trillion, we'll discuss the investing landscape with the help of some of the country's finest money managers. A bubble is when asset prices rise drastically, often defying fundamentals. When we conceived this topic, markets were booming, and now there is a reversal in fortunes with the markets correcting sharply. With that, I would like to bring in Mr. Gupta and Mr. Patil first. I would like to ask you whether valuations are now more compelling, and also with the election results now out, how does this change things for the Indian market?
Sure. So before Mahesh, let me take the first go. So I think, yes, last month we saw correction. I think after nearly 3-4 years, we have seen in a single month the market correcting by about 7%. But I will not really say that the valuation excesses have gone away from the market, because one prime reason besides the foreign money outflow was also that we did not have such a good earnings season, right? So if you see the September quarter results that came out, nearly 45-46% of the companies missed earnings, and there were earnings downgrades. Right. So if you look on a simplistic price to earnings basis, the market, despite this fall, has not really become cheaper because earnings have also got downgraded. Right. So I don't think the valuation comfort is back just as yet. But again, I would not want to paint the entire market with the same color. There are pockets in the market which are good value. There are pockets in the market which, as you say, is in the bubble zone.
Fair enough. You would like to also answer the election bit, and then we can go to Mr. Patil.
Sorry, which?
The US election, now with the election results out, how does it change things for the Indian market?
So I think we will come to know about the policy direction that actually gets implemented in the coming months. But basis what has been already announced was part of the campaign, I think one thing is very clear, that you are going to probably see higher US fiscal deficit and potentially higher US inflation for longer. I think the market has started estimating this over the last 2 months, and that is why, despite Fed rate cuts, bond yields in the US had actually gone up, and that was the other driver why you saw the foreign money outflow. If this trend continues, if US rates continue to remain higher, I think prospect of foreign flows will remain weak for our market. So I think that is a negative that we have to bear.
Thank you. Mr. Patil, can you come in now?
Yeah, hi. So I would say, I mean, clearly market is, we talk about a bubble territory, right? I think it's bubble territory means where you are looking at a market where it is, I mean, at the extreme end of the valuation and also at the peak of the economic cycle, right? Where everything at its peak, your sentiments are at its peak, your liquidity inflows are at its peak, valuation, economic cycle. So I would say that, again, as Ashish mentioned, pockets of the markets are, if you look at Nifty, for example, right? So Nifty, the multiples, right, what was pre-COVID, if you consider market pre-COVID was not in a bubble territory, we are similar to the same multiples, okay, for the Nifty, where it was pre-COVID level. Obviously, the earnings growth momentum has been very strong in the last 3 years. This year is slowing down from around 20% CAGR to now, say, kind of a single-digit growth. And to that extent, I think, I mean, the growth also, what we saw in the market was backed by earnings, at least on the Nifty front. So I would say there it is. I mean, markets are never cheap. Indian markets have always been expensive, okay, because the relative growth differential for India looks still fairly good. I mean, if you look at the world economies, I mean, US probably after these elections, the growth outlook there would be slightly better, so it will compete. But otherwise, India growth at around 6.5% GDP will still be good. And the profitability, if you look at, right, of Indian companies, what it used to be around 4 years back, pre-COVID, and now the ROC and ROEs are much superior. So that would also imply that the valuations can be slightly higher, right? If you look at multiples of a company, you look at the return on equity, and also the macro stability is much better than what it was, say, 5 years back, right? In terms of whatever you look at in terms of a current account deficit, in terms of the rupee volatility. So I think in that context, the risk premium, what the market is to get earlier, I think there is a reason for that to compress a bit. So I would say if you take all these factors into consideration, market is, I think, fair. At least the Nifty, I would say. The large caps are fair in the fair zone. And yeah, small cap, mid caps, there clearly we had seen a big rally, a big euphoria there. A lot of money has gone into that space. So there, I think one needs to be a bit careful over there, because now with earnings momentum slowing down, I think lofty valuations where they are, I think they are likely to be at risk. And we've seen that in this quarter, in the last 2 quarters, wherever companies have disappointed slightly now, we've seen a sharp reaction in those stocks, which was not the case earlier, right? So I think in that sense, there is some change. I think post election results, we have seen the character, the color of the market is changing now, right? Clearly the leaders of the earlier this thing are now giving way for some of the other sectors and stocks.
Thank you. Mr. Tawakle, you run a small cap fund. So investing in small caps has been the flavor of the season, and valuations there are pretty high compared to their long-term averages. So would you like to come in here? How does the small cap?
Actually, I run a large cap fund and I run a small cap fund. And my large cap fund is much larger than the small cap fund, fortunately. See, we've actually closed our small cap fund for inflows some time back because we felt that valuations had got out of hand. I'll just use a slightly different definition of a bubble, right? A bubble is when, if stocks fall 15% and then people wake up and realize, oh, this was not a great company, and then they come to sell, then you say that stock was in bubble territory, right? A market being 10% overvalued is not a bubble for me. Right? And I do think in the small and mid cap space, there are many companies I would say, where people have not looked at the risks, people have not realized that these companies are not as strong as they are claiming to be, and I would say they are in bubble territory. Now, what one has to be cognizant of is that, look, a lot of, I feel that in India, even corporate governance is cyclical, right? A lot of these companies are coming, raising capital. So when people ask me, why are FIIs, there are FII outflows? My question is, why are there so many promoters selling? That is the more relevant question. Why are so many promoters diluting, right? So a lot of this, will ultimately have to sort of adjust. And you will find that a lot of companies that are giving lofty guidance today will disappear, right? In the sense, have no communication later, and you will find it difficult to get a meeting with them. So one has to be fairly careful in the small and mid-cap space is all I would say.
No, but if promoter selling is a red flag, we often see mutual funds are the counterparties to most of the block deals. So, I mean, how does one read that situation?
So I leave that to, I've managed the small cap fund for about 1.5 years. I've managed the large cap for much longer. I have tried to stay away from a lot of these, but people who handled that successfully perhaps can answer it better than me.
Oh, Mr. Ban, I would like to bring you in here. You run a large small cap fund, which is one of the largest in the industry. How do you see valuations in that space?
See, the trouble with the bubble is you will know only after it bursts, right? So today, while certain segments are good and sensibly priced, but nothing is cheap in the markets today. And the problem is the bubble may not just be only in valuations, it's also in the mind of investors today. A lot of people are coming in with return expectations which are unreal. And if you look at allocation of money in the last 6-9 months in mutual funds only, a huge amount of money has gone into sector funds which have done well in the last 3 years. So the challenge is, yes, there is certainly euphoria, there is certainly this, and it continues. That's the nature of the market, right? When more money is chasing a lot of less amount of equity in the market is always this valuation challenge. The second question on yours on the promoter side, promoters selling. The promoters are finding their valuation so expensive that they want to reduce their holding, right? And what they are doing with this money is investing in mutual funds so that they can diversify their exposure to a single company. So clearly, nothing is lying free in the market today. And like Anish talked about, we have to be extremely careful in terms of the kind of companies we invest in. Our basic principle is if you want to invest in a company today, if you can't afford to be a buyer in the company 15-20% lower by design because the business model is shaky or whatever, then those are companies to leave it today itself. They are companies not to chase. Within the small cap space, small cap is a very large space. Other than the top 250 companies in India are small caps, right? Clearly, if earnings don't improve from where we stand today, there will be challenges. So for that very reason, about a year back, we have made only flows through SIPs in our small cap fund, and just making sure that we keep it far more diversified than usual, and obviously working on quality of businesses at all points of time.
Let's get in some fixed income perspective. We have two CIOs on the fixed income side. Given the post-COVID equity boom, debt investments have taken a back seat. Net inflows into active equity funds over the past 12 months are more than 3 trillion, while that in the actively managed debt funds are less than 1 trillion. Also, this disparity stems from the fact that equity returns have been very impressive. If you look at a 3-year annualized return for the equity, large caps have delivered 15% annually. Small caps, the returns are even higher at 25%. On the other hand, most debt funds have delivered returns which even fail to beat the inflation on a tax-adjusted basis. So, given that context, I would like to bring in Mr. Jaju and Mr. Radhakrishnan. How are debt schemes? What do they have to offer in the current environment?
Yes, so I think the way you describe, I think the real life situation is much better than that. So let me share some data with you. First of all, the bank deposits grew last year by 23 lakh crores, right? And the mutual fund debt AUM, I'm talking of October to October 23 versus 24. So the debt AUM of the mutual funds grew by about 2 lakh crores. So from 13 to 15 lakh crore. The equity AUM grew from about 20 lakh crores to 32 lakh crores, so 12 lakh crores. The net equity new sales is 3 lakh crore, out of which SIP is 2 lakh 25,000. So all in all, in the best year for the equity market, you have net equity sales of 1 lakh crore. So this entire glamour about equity is shared by very few people in the country. So I think there is a reason to be optimistic, because I think all of us are discussing that the reach of the mutual funds is just about beginning to expand. So we are very positive on the equity side. Now you talk about the debt side, the same thing applies, because today, because of the tax incentive having been withdrawn or because of the lack of awareness, people are investing 23 lakh crores of fresh money into bank fixed deposits, which not this year, not last year, since the inception of the banking system have never beaten inflation. Whereas the debt mutual funds are the products which are market related. The best possibility of any option, any product to beat inflation is when it is a market related product. So the best option on the debt side is the debt mutual funds, which the investors have still to understand and adopt. So you go back 10 years, there was a lot of, similar situation about equity funds. So in the first leg of the growth of the mutual funds, the equity has picked up. It's a natural progression. So I think that for me, the way I look at things, I think things are looking very positive. Now the second part that you talked about is the return on the debt funds. Now, look, cricket is a very popular sport in our country. So I'll just take a little reference to cricket.
Sure.
There are times when India was losing all the time. Then there was time when India stopped losing. Then India started winning. But when did India become undefeatable, the number one team, right? I'm taking a few seconds longer because that needs to be heard a little more. So when Gavaskar was there, India was still losing, even though he was world class. When Tendulkar came, India started winning once in a while, right? When Dravid came, India started losing, stopped losing. But when Sehwag came, when Yuvraj Singh came, India became indefeatable. So the point I'm making you is that unless you have a diversified portfolio, right, you cannot become undefeatable. You need a Sehwag to win, you need a Yuvraj to win, but you need a Dravid to not lose. You are indefeatable when you don't lose, not only. So I think there is a space for every asset class, and things are, I mean, India is still a growing market. We are still trying to push the debt too hard. Today, there is no difference between taxation of a debt mutual fund and a bank FD. But such a negative impression has been created as if debt mutual funds are having a tax disadvantage, which is completely false. We had an advantage which has been taken
Now it's a
away
more
by
level
the.
playing
So I
field.
think the way,
Right.
so the point I'm saying is that in terms of the possibilities for future, there's reason to be optimistic than say, oh, my return is poor, or, you know, my corpus is not growing. No, this is just the start. We are making the base. Thank you.
Mr. Radhakrishnan, can you also make for a compelling case to invest in debt at this juncture?
Yeah, in fact, so we need to accept the fact that, of course, there have been certain adverse taxation changes in the last few years, but just leave aside that fact, even sort of to connect with the topic here. I mean, debt is one segment today where we typically don't speak about valuation so much in debt, but I think it's time to start looking at that as well. So, I mean, how do I look at it? You said real rates. I mean, at this point in time, if you're buying a 1-year AAA bank CD, you get it, or maybe a 1-year AAA bond, you're getting something like 7.5 to 760. So you can construct a portfolio with a 1-year duration with high-grade instruments at around 7.5, 760. Even if you are assuming that the next 1 year ahead inflation is not 4.5, RBI's projection is 4.5. Most of us think it could be slightly even lower, but let us stress it, say it goes to 5. You still have more than 2% real rates, real return on a prospective basis. And I think that's one clearly compelling argument on fixed income today. And I'm not even talking about any capital gain that may come if interest rates go down. I mean, that's just leave aside that. So purely from a very, I would say, HTM or a hold to maturity investment on a 1-year prospective basis, you have visibility of real returns. And whenever in the past, when you've looked at it, when you have real returns being on a prospective basis visible, the outcome from a debt investment has been quite, I think quite attractive. And I think we are possibly in a very similar phase there.
Okay, fair point. Let's now come back to the equity side. We'll delve a bit more into the FPI investments and earnings growth. FPI holdings in Indian companies are at a multi-year lows. And we have seen record selling in October. So it looks like FPIs have been tactically reducing their India exposure. A lot of funds are overweight on India. So is FPI outflows an impediment for the growth of the Indian markets?
So I think if we see last 5 years, that has not been the case. So last 5 years, clearly FPIs, in fact, from 2021, have been underinvested in India. Just to put some numbers, I think 20 years ago, FPIs were about 25-26% of the market. Today, they own about 17-18% of the market. So their shareholding has come down because Indian retail and Indian mutual fund shareholding has gone up. And the domestic flow, and we heard all the numbers in the previous panel as well, has been more than able to offset the outflow. I think while near term looks challenging given what's happening on the US yields, on how quickly FPI flows will turn, but I think medium to longer term, India remains one of the best growth stories out there. So I think foreign money will come in. The other interesting fact is that this lack of FI investment in the last 4 years has happened at a time when India's weight in the indices, global benchmarks, has gone up. And if you look at the emerging market benchmark, India's weight in the last 5 years has gone up from about 8% to 18-19%. So considering that, FIIs are actually very underinvested in India, right? So at some point of time, they will have to come back. But if I look at the more closer term, There is the fact that FI investments are likely to be lackluster given what's happening on yields, and simultaneously there is a big increase in supply of paper, as Anish also mentioned, promoter selling that has been happening, the number of IPOs and QIPs that are hitting the market. So I think in the near term, that is a challenge. I spoke about this in another event a couple of days ago, that in the last 3 years, domestic investors were able to offset the FII selling, right? But that was because the supply of paper was not large, right? So if I see the pace of supply of paper now, that will be about 4-5 lakh crores over the next 12 months. So we will need foreign investors also in addition to the domestic equity supply, equity demand.
Yeah, fair point. Would you like to also come in, sir?
No, I just, I wanted to address the sort of latter part of your question, whether it affects economic growth, right? See, we've had a very sensible policy of keeping a limited, restrained current account deficit, right? And ultimately, why do you need inflows? It doesn't matter whether it's FPI, whether it's FDI, or whether it's borrowing. Ultimately, you need foreign capital inflows to supplement domestic savings and to fund your current account deficit. Now, as long as our current account deficit remains in check at about 1 to 2%, we should not spend too much time wondering about where it will come from. 1 to 2%, as long as your deficit is small and restrained, funds will come. And whether they come this month or next month, it doesn't really matter. Whether they come as FPI or FDI, it doesn't matter. Or whether we do a little bit of ECB, it doesn't really matter. From an economic growth perspective, the important thing is that the current account deficit is in reasonable shape and investment in the economy is picking up.
Okay, fair point. Mr. Patil, you talked about earnings growth. Post-COVID has been, the growth rates have been high, and now the first half has been quite a disappointment. So is that a new normal? With the post-COVID, stimulus measures now over, will growth be more challenging going ahead? Earnings growth will be.
So if you look at the growth wise, in the last 4 years, if you look at, right, the earnings growth has been driven by a lot of improvement in the operating margin, right? So if you look at the top line growth in that period, was not very high. It would have been around, say, slightly higher than the nominal GDP growth, right, around 13-14%. It's not unlike in the earlier bull run what we had, right, in 2003, 2008, where the top line growth was like 22%, 23%, right, and earnings growth was around 25% CAGR. So it's been driven by operating efficiency, margin improvement, okay, to some extent improving balance sheets, right, which have deleveraging, which has led to a higher bottom line growth. I think that to a large extent is now behind us, and we've seen that now the earnings growth is converging to your top line growth. And as your top line growth, I think, would be driven to a large extent, by and large, in line with your nominal GDP growth, which will be around 10, 11% or so in that region. So I would say that this year probably there is some amount of some normalization which is happening, and that's why we've seen the growth slightly tracking below. But I think if the GDP grows at around 6.5%, nominal GDP at around 11% or so, I think earnings growth should probably track in that range going forward. And a lot of sectors, it's not like we are seeing any major challenges in any sector, right? So there is some slowdown we've seen on the consumption side, where last couple of years has been slower. That is likely to improve. It's been slightly delayed, but rural consumption and other areas is slowly picking up, so that should support. Whereas the growth has been driven to large extent by the investment side. Government spending has been very strong in the last post-COVID. That is slowing down. So I think some amount of, that rebalancing has happened. Investments were tracking ahead of your pre-COVID trend. Consumption is still lagging. I think that will probably normalize again. So I think I would still believe that India earnings growth for the market, say if you look at Nifty, would still probably grow in the low teens from a medium-term perspective. This year, probably you would see it slightly lower than that because of the strong growth what we have seen in the last 2-3 years.
Mr. Ban, would you also like to comment on whether the post-pandemic growth party is ending? What are your views on this?
Like Mahesh said, the problem is the top line growth is very weak. Not today, now it's about 6 quarters. And we are at reasonably peak margins. because most companies are reporting the best possible margins till this quarter. So I think with a lag of maybe a few quarters, earnings should trend higher than where we stand, because trending below the nominal GDP growth rate as it is for earnings on a sustainable basis may not be easy. Second is the starting point today is a little more difficult for a stronger earnings recovery unless everything recovers. India is no longer so small that you can't, you need a broader global growth to be good. You need many things to work to be delivering that 15% plus kind of growth rate. Earlier, when our bases were very small, we have done 22% revenue growth, 25% earning growth for a long period of time, 3, 4, 4, 5 years. But I think today we would have to work with improved earnings from where we stand, but it has to be the lower teens as maybe within 10 to 15%, 10 to 12% over a medium term is what we think at the moment is possible.
Fair enough. We'll soon open the floor for questions from the audience. Before that, we'll go back to our fixed income CIOs. So now even the older generation is, pivoting towards equity investment. What would be your advice? How does one, approach the fixed income space? If you are an investor, if you want to come in at this stage, how does one sort of approach this space?
I think eventually it boils down to individual asset allocation choices, right? Would you really want to be 100% invested in equities? Quite possible. Some people possibly would have that approach. But I think end of the day, given we did speak about relative valuations on both asset markets. So I think for a normal investor today, would you really want to diversify? I think you need to. And possibly given where we are today in the rate cycle, a lot of fixed income products do provide value that gives you the diversification in your overall portfolio. Or the other approach could, of course, be to approach fixed income investments through the hybrid category or the balanced products. So I think these are the various options that you have. But I think end of the day, it's an individual choice. Whatever allocation that you are comfortable based on your risk tolerance and your timeline, I think that really matters.
Investors generally, when we meet equity investors today, proudly say they are 100% into equities. Right. That itself is a signal that a lot of things are bubbly for us.
Fair point. Mr. Raju, would you like to add anything?
No, sure. As Rajiv was saying that for different people, the risk appetite is different and the investment objective is different. But debt at a conceptual level, like we say that we have 140 crores debt investors in India because there is no one who has zero debt in his portfolio. The challenge that we are discussing here in the context of mutual fund is how do we get those investors into mutual fund? Debt as an asset class is not challenged because even when the returns were negative, the bank deposit rates were negative, even at that time the deposits of the European banks were growing. I think the context in which we are discussing debt that needs to be redefined. The challenge that we have as an industry is how do we get those investors who are investing even today at 2% in the savings account when my liquid fund is giving 7.5% return. What do I do to get him to invest in my liquid fund? That is the challenge. To pitch debt as an asset class or as an investment option is not really required because you have 140 crores investors in debt in our country of 140 crore citizens, right?
Yeah, that's a fair point. Our salary gets credited every month, and there's
whenever we're discussing debt in the context of mutual fund, we question it wrongly. The question should be how do we get these people?
No, there's a lot of inertia, like your salary gets credited and it lies in your savings account. So a lot of us, don't proactively. If you don't want to take the risk, equity risk, at least you can, park it with a debt fund. But most of us.
Yeah, that's what I'm saying. So when we talk about debt in the context of mutual fund, and I think we can see a hint of that even within the panel, we talk of equity versus debt. It's not equity versus debt because debt is universal. Like there is a lot of debate within equity between active and passive. It's not a debate. You need both. So therefore, I think we need to redefine the way we discuss debt than to discuss if debt is a required, product in our investment universe or not.
Fair point. We'll take a few questions. If anybody has any question, please raise your hands. There's one lady at the back, please.
thank you first of all for such an insightful session and discussion. Manisha here this side, I'm from ISI Markets. We are an economic information company. So my question is that earlier equity was very simple. Either you're going full in or you're taking the mutual fund way of entering the market. But now international funds have also come in, right? Now we want international exposures. So my question is that if we are exploring international investments in form of equity, so what are our view in exploring that horizon for debt market? Or is it already there and we aren't aware about it?
Are you asking whether you can invest in international debt?
So my question is that how easily we have made it available for retail investor to enter into international equity segment because through ETFs and various funds. The same way, if we have to explore the horizon of debt of international market for retail investors as well as other stakeholders for that matter. So what are easier ways and is there like lot of possibility and opportunity there?
So I think through the mutual fund route, the ability to invest in international stocks, it's governed by that overall limit which the RBI and the regulators have provided. And as I understand, the limits are exhausted until the RBI gets comfortable opening up investment limits further for overseas investments. Today, you don't really have a route to invest in international debt. Now, but why did you really want to invest in overseas debt if
Exactly
where
right.
yields are? I think India is the right market. In fact, as a domestic investor, you should be really comfortable investing in our bond markets where the yields are relatively attractive, where we are in the face of interest rates. Potentially, you could get capital gains as well. So I think right now, you should not really be thinking about international debt investments. Possibly at some time in future, when the limits are open, possibly you may get some opportunities.
Unless you invest in a high-risk country, the yields are much...
Yeah, no, I would say that, I mean, at times, okay, there are, I mean, currently the limits are full, but there are products, right, where you can, like, we have launched a US Treasury bond fund, okay, around 6 months back, okay, when US Treasury yields had gone up to 5% or so. And there could be some merit over there because there are opportunities, like if you look at the differential between the US Treasuries and India, it's the lowest at this point in time, right, historically. So if you look at, there is the rate cuts, probably what you will see in the US could be much sharper than here, so you could get some kind of gains over there. So yeah, I agree, there is an opportunity there, okay, to invest tactically, I would say, yeah. And again, you're looking at dollar returns, right? How rupee also. So I think there are, but currently, because the limits are full, but whenever it opens up, there could be merit tactically to play in the overseas, the US, especially in the US debt side, depending how the duration is playing out over there.
Yeah, we have one more question from there. Yes. Please pass on the mic.
Hi. This question is for the equity CIOs. You know, the industry has been continuously talking about moderating return expectations for the past couple of quarters. But thanks to momentum and fund flows, that hasn't happened. What makes you think that those return expectations are going to moderate when the momentum and fund flows continue?
Anybody who would like to take this question?
So I think, see, again, in the, I mean, flows, again, we have seen they tend to be a bit cyclical also, right? When everything is good, outlook is good, earnings momentum is strong, we see the flows continue, and also flows to some extent are also governed by the sentiments, the past returns. What we're seeing is that there is clearly earnings momentum is slowing down than what it was in the last 3 years. We talked about that. And the returns also now, as I said, the market returns have, especially broader market, right? Because in this last 6 months, we've seen that while the market is only down 7% or so, there are many stocks which are down more than 20%. If you look at the breadth, it is starting to weaken. So clearly, the returns are already starting to, if you look at on a 6 months basis or 1 year basis for individual investors, will start to slow down. So that could impact the flows also. I'm not saying the flows will continue, but again, as I said, the supply is also coming in, right? We've seen now the supply. Up till now, it was coming in from the secondary side, okay, promoters selling, but a lot of companies would start to raise capital for future growth, okay, which we haven't seen in a big way. And that would, to some extent, match the demand, right, which is coming in from the strong flow. I think supply, as Ashish also mentioned, we are seeing a strong supply of paper coming in. So I think that would address, okay, in terms of the demand-led pull what the market was seeing. And that was seeing the divergence from fundamentals a bit in a few stocks. I think that could correct, and that could be a reason. We're already seeing that, right, in the last few months. That's happening. So I think it's not given that the money flow into the markets, while we think that we expect that the SIP flow will continue. I think that's the best way the market is coming in. But again, on the other side, you have to see the supply side also, and that can also probably moderate down a bit depending on how the recent volatility and the past recent experience of the market has been.
See, any argument, right, which is investing argument that's based on flows is essentially an argument based on the greater fool theory. We can do a lot of sophisticated analysis to understand the flows, but if you are hoping that flows will continue, you're hoping that there will be a greater fool to cover up for your mistakes. So it's not good to make an argument on flows in the first place, right? The argument should be on what's fundamental valuations that will sustain. Because it's only then, if you've made the argument based on fundamentals, if it falls 15% because of flows, you'll be able to come in and buy. If you've bought on flows and then the flows disappear, 15% later you'll want to sell, right? So don't base arguments on flows because they're essentially arguments based on the greater fool theory.
We're almost out of time. We'll take one last question. Keep it short.
Yeah, I'm Dikshit here. So no particular opinion about any sector, but we are talking about bubble zone. So why does such things happens that when let's say any particular sector, for example defense, where almost all the stocks went up by 5 or 10x, and then we see a sector dedicated funds. Let's say we are not seeing a dedicated sector funds for stocks which have not performed over the last 3-4 years.
I would also like to add here, like you guys have, responsibilities towards the investors as well as the fund house. So how does one balance that? Like the gentleman mentioned, you launch a fund at the peak of, the cycle. I mean, how does one sort of approach?
So I think our strategy has been that yes, there has been both investors ask for sector dedicated funds. Investors have also gotten more sophisticated over time, at least part of the investor base. So our endeavor has been to do thematic funds which are very broad themes. So which is not just one sector, or the investable universe is not 15, 20, 25 stocks. There's not high concentration in a few names. So about 15, 18 months ago, we had done a manufacturing theme. About 3 months ago, we had done a consumption theme. Within that theme, there are about 12 to 14 different subsectors that you can invest in. And really, in every phase of the economic cycle, in every phase of the market, there are some components of that theme that will be doing well. So there are diversified opportunities. For very narrow sector themes, we actually recommend investors who want to take exposure to do it based on passive funds, because there we are not making any active call. If an investor wants to buy one particular sector, say for example, he just wants banking exposure, so there's a banking passive fund.
Fair enough.
I mean, let me just add, I think sector rotation, I mean, sector funds, again, you have to do some amount of timing is required over there to do that. And invariably, money comes in, okay, looking at the past returns, right, in a particular sector. So I think the best way to approach investing into sector thematics would be through a sector rotation fund of fund. Now, fund of fund also becomes a very good option for investors to invest, okay, participate in the mutual fund without worrying about the tax. So where we have a framework, right, where we decide, okay, in terms of how each sector is placed based on the profit pool, the market, the valuations. And I think that can be a good approach for investors to come in and play sector through a sector rotation fund, through a fund of fund route.
Yeah, with that we conclude this session. I hope it has given you enough, it has given you valuable insights into investing. Yeah, thank you.